are three major areas when it comes to finance in our operations, in our business. And I think some of us might be aware. We normally look at what? We have the operations, and then we have what? We have the investing activities. These activities we do. Okay. And then financing activities. Okay. Investing activities. Okay. So with any form of business that you are doing, when it comes to finance, you will look at operations, your day-to-day activities that you are doing, you look at it. And then when it comes to investing activities, you need to invest. Most often, you need to buy equipment. You need to buy, what else, apart from equipment, what else do you need to buy? Vehicle, you might need a vehicle. Right, water tank. Okay. And what are the major things that you invest? Machines. Okay, good. Yeah. And we need money to do the investments. We need money to invest. So investment activities. Laboratory equipment. Laboratory equipment, very important, especially if you are in the food, if you are in chemicals, production of these herbs. You need all this. And then financing. We have to finance the activities. And that's where most often we look at where? The sources of finance. And I think that one we will not really worry ourselves too much, because those of us who have started, we knew how we got our money to start our business. You are already in it. Where did you get money to start this business?
From my own resources.
From your own resources.
And then, yeah.
When you were starting? Yeah, from your own resources.
Yeah, the very beginning.
Okay.
Was, my own savings.
Your own savings. Okay. So you got money from your own savings. Okay, good. What about you? Where did you get money to start your business, your shea butter business?
From my own source, and then grant from Comfort.
Oh, okay. Oh, Comfort. Okay, so grant, and then her own resource savings.
My ESB.
Your
ESB.
end of service benefit. Okay, which is also still your own savings. Yeah, ESB. Okay.
I sold the car.
My own source is a senior cosmate.
A senior cosmate.
Together, he brought the money and I did the work.
Oh, okay. So that's equity from another friend. Or was it a loan?
No, just for one exhibition. After I gave him his money, I started with the.
Oh, okay.
Wow. So did you add interest?
No, it's not a loan.
It wasn't a loan. You came together to do an exhibition.
We got the money, I got mine.
Your samples.
I still went, I did the work.
Okay.
So after we shared
The
the profit.
profit.
Oh,
okay. And out of that, out of the profit.
I started with
Wow, that's interesting. So, okay.
I started
You.
It was JJ's salary.
Hey, Jerry, it was your salary.
Yes.
Hey. Wow. Good. So there are so many forms of money, source of funds that we use to start our business. And when it comes to operations, where are we getting the money from? Operations, where should we get the money from? From operations. Where would the money come from? When we are running the business. Revenue.
Sales.
Yeah, sales. Yeah, sales. Okay. Good. We'll get money from sales. And then once we get our sources of funds, then we are able to do the investments that we want to do. He wants to purchase a lab equipment. He needs money. Now you have already started, right? So where would the money come from?
We will get the investors to.
You are still looking for investors. Okay, that's good. Oh, that's a serious business.
That, we are now going to an advanced technology. The production line has changed.
Okay.
Those
Okay.
ones were doing before manual.
Yeah.
Manual system producing with all
The powders.
So now we have to do something which we can close.
Okay.
Everything will go from one stage to
It's like an assembly line.
assembly
Okay.
line.
Okay. Automation.
So it will require a lot of money.
Sure.
Before we started with just a few thousands, we are now going to millions. So we definitely need investors.
Investors. Good. Now, if once we need investors to come into our business, then we have to show them something, because nobody wants to put his or her money in a place where you really don't know what you are going to get out of it. If it is your own money, you know, people are risking their resources, some as much as their end of service benefit, and then they put it in a risky business. Somebody sold his car. This guy has to come up with a salary to start a business. And we do all these things, and when at times when we start a business, then managing it becomes a problem for us. So we need to show them that yes, this business that I'm doing, it is profitable. When you put your money in, you can get your money back. It's not like maybe when we were starting, some people helped you out. But now that you are in business, you have to prove it.
Yeah.
You have to prove it that yes, this business is what we are supporting. Otherwise, nobody will come in. We want to look at our financials, and we mentioned operating activities, which is mainly our production issues. Okay. Now, once we are able to go through this operating activities, which include the production, sales, and delivery of the company's products, as well as collecting payments from its customers. So it's not only producing, but collecting. We need money to finance everything that we do. Once we are in operations, we actually want the money that we put in to come back, and even come back in multiples. Otherwise, the business will cease one day. Whatever we put in, something should, there should be a multiplier effect. Otherwise, you go out of business. And we should be able to pay salaries. So, from these operating activities, what should come out of it? We should be able to determine our net income from the income statement that we build. Then the depreciation. Basically, what is it? Wear and tear.
The reduction in the value of the product.
Yeah, the reduction in the value of, let's say, an asset. Good. For example, we have computers over here. This computer has life. It will die one day. But how many years would it last, realistically? Some will say 3 years. Some will say 4 years. So, but there are standards. In accounting principles for each country, if you want to depreciate computer, you cannot say that I'm depreciating the computer for 10 years. It will not be allowed. There are principles guiding the depreciation, the type of depreciation that you have to use. We have they call something the straight line. Let's say if it will last for 5 years, then it means if it is a straight line depreciation, then every year you have to write off 20% of that particular asset. You see? So if it is what we bought the computer, say 10 million, and every year 20%, which means how much will I write off a year? 2 million. Right. So every year 2 million will go. So if today it is 10 million, next year it will be what? 8 million. The value of the asset will reduce to 8 million. The following year it will go to 6 million until the final year is off, which means that you need to replace it. And as part of the business, you need to be thinking about it. The machine will not last forever. The manufacturers will tell you that this machine will last for maybe 20 years. Vehicles, maybe 5 years. And if that is depending on how you use it.
Yeah.
Because it may be peculiar to your company. Looking at the rules that you are using, then for this machine, you might not be able to depreciate it for so long. You need to be thinking of replacing it. And that is what we call depreciation. Everything in this world, maybe almost everything, apart from God, human beings, we also depreciate. Yeah. Yes.
So in other words, every asset
Has a useful
has
life.
useful life.
Right. Yeah.
Now with this depreciation, I
Yeah.
want to find the essence of the depreciation. Does it mean if I've used it for 2 years,
Yeah.
then the value that is left,
Uh-huh.
let's say I'm valuing my company at that time, that's the value I have to use. Is that why we are doing this depreciation? Because you say you are writing it up.
Yeah,
So that value left, what are you using it
That value left is what we will call the book value. The book value of the asset.
of the assets?
But when it comes to, let's say you want to sell the assets, that's a different game.
So
That's a different game.
So what's the
There's
importance
a-
of keeping the book value? I know at the end of 5 years I will discard it, buy a new one, but why am I keeping it in the books?
Oh, why are you
The
keeping
value,
in the book?
the remaining value, why am I keeping it there? What does it do? Do I use, does it mean I put that money
No.
aside?
Okay,
I don't know if I'm
for
clear.
depreciation, there is no money that you set aside for the depreciation, unless you decide that you are creating a sinking fund, a fund to replace the assets.
All right.
But for accounting purpose, we are required to write off the asset that we have every year. What portion of this asset has been used? You see, that portion of the asset, then we quantify it. But there is no cash
All right.
actually that we are saying that we are putting it aside, unless you decide that I'm creating a sinking fund, and that fund every year I'll put so much in, and then I'll use it. Okay.
I told it was part that
Okay.
it's something you add to your cost before you calculate your net profit.
Yeah.
So it's a cost you don't see.
Yeah.
All
But
right.
it's actually an indirect cost.
It's an indirect
that you have
cost.
to calculate as part of your net profit.
Right.
And so the value that's left is what comes to your asset. But then your asset doesn't show the value of the company. The value of the
all right.
company is the assets.
Yeah.
They are different. Yeah. When it comes to valuation, maybe if we have time, we'll just quickly mention some of the methods that we can use to value the assets. Okay. Then we have non-cash items. For example, depreciation is really non-cash item. There are certain items that we are not using cash for it, but we record it as part of our statements. Then there's a deferred tax. Let's say you have to pay tax today, but you don't have the resource to pay, so you can defer the tax to maybe the following month or the following year. Okay. We have interest amortization. We all know how interest, whenever we contract a loan, there's an interest, and that interest we need to pay it over time, depending on the terms and conditions attached to a particular facility. Some facilities maybe it's a short period, some 6 months, 1 year, 5 years. If it's a long term, it is more than 1 year. It means you have to be paying interest on it. And there are so many ways of calculating interest. If you borrow from the microfinance, the way they calculate the interest will be different from if you borrow from a traditional bank. Okay. And these are all costs. And then accrual items such as wages payable. Well, this, we all pay wages. We all pay wages. If we have employed people, we pay them. But at times, maybe you are supposed to pay them at the end of the month. But unfortunately, something went wrong. And this is a small company. And you agreed with your staff that this month is tough for me. So please, can we defer your salaries? And that's serious negotiations for them to understand. I mean, it's not easy for them to understand. Maybe next week I'll pay you. But the month has ended. So assuming you are preparing your, you are preparing, let's say, your balance sheet, which this one will feature. The wages that we were supposed to pay this month, you couldn't pay. So it's something that is outstanding. It will stand in your books that you have not paid, and we will call it wages payable. It's an obligation for you to pay, but you haven't paid. And investing activities. Okay, let's quickly touch on that. We talked about investing already. And these are things that we need to invest our money in. Capital expenditures, we did mention. Purchases of equipment. And there might be other investments that we also have to do. We may have to invest in other things. Example, you have excess cash. or even your company might decide to buy a share in another company. It's also an investment that will bring returns to your company. Okay, the statement is actually looking at cash flows, but I would say it's too early to follow, but let's see what we can do. There are so many items that go into the cash flow, preparing the cash flow. But what we really know is that for preparing the cash flows, we have to look at the three main areas: the operations activities, the investing activities, and then the financing activities. We need to know we are preparing the cash flow for which period. Is it monthly, annual? But for us, what is critical is that we look at the monthly cash flows. Every year we should be able to prepare our monthly cash flows. So before we start 2014, we may have our cash flows there month by month. What is going to happen? First, we will consider operations. Operations, we will look at all the monies that we are going to receive month by month. The operations, we are making sales eventually. So we will look at operations. Okay, we will look at our receipts. Okay, basically, let's just look at our sales. We are a small company. We only sell something or produce something and sell. So we'll look at our sales. Let's just take only few months. We are now in what? April, May. So let's say June, July, August. Sales that we make in in June. Very simple, 2,000. Small company. July, we expect that it will be 1,500. August, we may shoot up to 2,500. Okay. There's our sales. We are selling. But we want the receipts. I'm talking of cash. But this is sales. Sales is just pushing the items to the customers. They bought it. But assuming there's a policy in your company that when you sell, you get 50% before you sell. You are supplying very good customers, and the arrangement is that they'll give you 50%. The next month, they will give you the remaining. Okay, so I will say that what am I receiving for the first month? Let's say June. Somebody say received during the month of sales. Okay. I'll receive 50% when I sell. So in June, how much will I receive? How much? 1,000. Good. This one will be what? 750. 1,250. Good. That's what I'm receiving. But what will I be receiving based upon the previous one? 50% receipt. Yeah, from previous months. Okay, that will be, it will be the same figures. Here will be what? It is 0.
It's 0. The first one will be 0.
You see?
Oh,
And then
we are assuming you didn't sell the month before.
No, you sold all right. But you are receiving cash 50% that same month. But the following month, you receive the remaining 50%.
What I mean is, we are assuming your sales started from June.
Yes.
You didn't sell this in April.
No. Yeah, we are. Okay. Good. Okay. So we are on the same page. So here will be what?
1,000.
1,000. And here will be what?
750.
750. So the next 750 will go into the next month.
Yes.
Please, do we understand this?
Yes.
Not yet. Not yet. Okay, let me go over it. We are saying that we make sales. We sold the item. Forget about the cash matter. it was 2,000 in June. July 1,500. August 2,500. But immediately you sold, you got 50% of the cash. The remaining 50%, the negotiations that to be paid next month, that's the following month. So the first month that you sold, you receive what? For the first June, that's the June that you will receive half of it, which is 1,000. And then the second, which is July, you sold 1,500. So you receive right away 750. And then August, you receive 1,250 from your sales. Good. The following month, in July, we sold 1,500, we received 750. The remaining 750, we will receive it in August. And it will continue like that. Good. So my total receipt. Here, I'll add this and then this. So I'll get 1,000 here. Here I'll get 1,750. And here I'll get 1,000. That will be 2,000, right? Okay. So you realize that my receipts are actually different from my sales. This is cash. This is cash. So in my cash flow, this will reflect as my receipts. The cash that I received for each month. So in June, I've realized that I'll get only 1,000. In July, I'll get 1,750. In August, I'll get 2,000. So when I'm talking of cash, this is what I'll be talking of. I will not pride myself that, oh, I made sales of this. What is important to me is the cash I'm receiving. Now, agreed. Good. Then we can do similar things for all the disbursements. We're going to do a lot of disbursements. What are some of the disbursements that will happen? Salaries. Utilities. Transport. Raw materials. Good. Raw materials. Packaging. Okay, let's just take this one. So now you know. So all these, there will be disbursements. This is under operations. We are now operating. But you are owing in April or even at the beginning of the year. And that has to be paid. It is due. You know, at times they give you something on credit and they give you a few months to pay. You didn't purchase it in June. You purchased it somewhere in April. It is due in June. So in June you have to make provision for it and go and do what? Pay. So whatever outflow, the cash outflows that will happen, we need to recognize all of them. We are looking at the current ones and then some you may have to defer them. But for salaries, most cases you pay at the end of the month, so we don't have a problem with that. Salaries, maybe 500. Every month is constant, let's say. Utilities, maybe it is 4. Okay. But even utilities, there might be a challenge over here. Who can tell me the challenge? Let's say you win. It's not the same every month. It's not, that's one thing. It's not the same every month. What else?
Maybe the bill came late.
The bill came late. Sure. And most often you have to pay it the next month. So we may realize that you take, say, water. Let's say all our utilities, water. Maybe you have to pay it not this month, but the following month. So even what we incurred in June 2000, we will have to pay it in what? July. So it is here that we will put the June expense. We are making expenses in utilities in June, all right, but the payment will occur in where? July. So that's where, when it comes to cash flow, we will put it at where we are paying. And the same thing applies to all of them. Raw materials. Some of them, this raw material, maybe you need to pay part, leave part. So you need to recognize when you pay. Good. And if we do all this and then we summarize, let's try to get some figures. T&T, small company, say 50. In this month, maybe we did very little, so even it has reduced. This month we did quite a while, so it's going to be 100. And then the raw materials, that one too, we are paying for it. For example, if you are doing tomatoes, maybe you have to pay for all the raw materials at a go, and maybe it's 1,000 here. Here we make about 800. Here 1,500. And then packaging. Packaging, you may have to buy even in bulk because at times it's not worthwhile just going every month to buy packaging materials. You may have to buy them and put them there for maybe 3 months. Some may even buy it for 6 months, depending on the nature of your business. Maybe your packaging, you will pay packaging in June. Let's say we are paying packaging in June of about 200. We will not pay something in July. And then maybe August we pay another 250 for packaging. So we are recognizing when we are paying. When we are paying. It's not about when we are using it, but it's about when we are paying. And the payables that Joe mentioned, maybe our previous payables, like the utility. Maybe we had to pay something for what we consume in April. We may have to pay it in June. So we recognize all that we were supposed to pay, but we couldn't pay, and now they are due, so we have to pay. Once we are able to do all, then we have to sum up. We sum up, and then we'll get all the disbursements that we have. And the difference will give us a net cash flow. The difference will give us what? A net cash flow. And that net cash flow can be positive or negative. Okay. We'll do a similar thing for the investments. When we are investing, what are we investing them in? Okay. When we are investing or making those investments, and then we have to look at the finance and how do we finance this major investment that we are making. And then we need to do the timing. When are we doing it? When are we paying? When are we doing it? When are we paying? Once we are able to do all this, then eventually we are going to get 3 sets of cash flows. If we do this one quickly, can we sum this one up? We get 550. 1,000 what? 1,750. Okay, I'm relying on you. And this one? 1,430. And this one? 2,450. Okay. 2,450. Okay. Assuming that's it. Then we can look at the net cash flow. Operations. This is mainly operations. So the net will be what we received minus this. So for here, what will 750 negative. And this one will be that will be 30, 20, 220 positive. And this one will be 450 negative. Good. Yeah. So what does it tell us?
You don't have enough funds. You don't have enough to fund those activities. January,
in June, we need 750 extra. And then in August, we need 450 extra to finance our operations. So if maybe at the beginning, we were to have cash there, at the beginning, if we were to have, let's say, 1,000 there, maybe to be able to pay for this, and then maybe pay for this one. But assuming it was 0, our cash balance at the beginning for operations was what? 0. So then what do? So if we're able to do our cash flows ahead, then we knew that in June we will need extra money. So we don't wait till June and then we rush, or April. We need to think ahead and work ahead and see where we can get the financing to support it. So this is for operations, and most often it is the operations which we find it's quite difficult coming up with our cash flows. The other one, that's the investment. That one is not very difficult to do. Okay. What we have over here on the board is another form of determining the cash flow. What we did over here, some they call it direct cash flow for operations. It is direct. What we got, what we spent, we do it directly. But in some situations, we use an indirect method of determining our cash flows. And this is what we have over here. Okay. In this particular one, we have to go through the income statement. We have to look at that the profit and loss. That's where we start from. But we start from our earnings. Earnings means, in some situations, we look at earnings before tax. Some situations we can look at earnings before interest payment and tax. That's our profit before interest payment and tax. Once we are able to determine that, that one will come from the income statement. Once we get that, then we start building our cash flows. It is different from this one. This method, to me, is good for us as small businesses, because here you are looking at each item one by one, one by one, one by one. But here, after you've been able to do your financial statements, and then you start doing the cash flows. You start with the earnings, which is depend on where you pick it. Good. Some might pick the net profit, others might pick the profit before interest and tax, and then you start working and look at what you have. This is earnings, let's say profits, net profit. Now we have a term called non-cash adjustments. Non-cash adjustments. It means here we are talking about cash. You know, cash flow is about cash. So in the earnings that we have, typically we may have a statement on an income statement. There are some items that we recognize. You remember depreciation, and you said that depreciation is an expense. So it's like an expenditure. So when we are preparing our income statement, depreciation will be cost. We will recognize it as cost. So it will be there. But when we come to the cash flow, this depreciation is a non-cash item. We've recognized that it's a cost, but now you are saying it's a non-cash item. So what do we do? Bring it back. So we have to bring it back. It's like it wasn't cash, it was in the income statement where we got our earnings from, so we have to bring it back, and we call it depreciation. We are adjusting it, we are adding it. It was not cash, but we made provision for that. Now we have to add it back. And then you mentioned other adjustments to earnings. There might be other areas that we indicated that, okay, this is an expense, but it's not cash, so we have to bring it back. And we do all those things, and we get net cash provided from operations. So we do the operations one. It was 1911, 1024, 43, and the sum is that. Did the same thing for 204. Okay. We go to financing. Some of these things might not be applicable to us. Process from issuing a new stock. For you want to be a new stock. Here, I think the company was traded in the stock market. And as a company, once a while, they need money to finance their project. So they float shares again. So they issue new stocks for people to buy. And normally when you are buying, you are paying money. And that is it. If you want an investor to come in to buy some of your shares, you can have proceeds from issuing that stock. You get money. And then payments to repurchase stock. That's another term, which I don't think... it's more like you you sold stocks, all right. Now you are buying back. The business is so profitable, or now you realize that you can buy your stocks back. And that's what it is. And then at times you pay dividends. We all know dividends. We pay dividends to who? Shareholders, or those that we have some obligations, preferred stock may pay dividends. Shareholders. Dividends, if you have a company and people have invested in it and they are, for about 10 years, 5 years, they are not getting any dividends, they start worrying you, my friend, what is happening to the business? Okay, so we get net cash provided from financing, but in your case, it might be different. It will not be the process, but it might be another source. It might be even a loan that you got from a bank for financing activities. Then what do? We bought equipment, plant and equipment. So that one too is cash outflow. Additions to property, plant and equipment. Like you, where you want to do expansion, you bought something. So it is an outflow. So we look at net cash provided from financing and then net cash used for investing. Once we do that, then we have to cash change in cash and equivalent during the year. Okay. Cash and equivalent beginning of the year, and cash and equivalent end of the year. And the equivalent is trying to say that other things that really is cash, or more or less cash. What we have this figure over here is this plus this plus, where's the other one? Sorry. This one plus this plus this. Okay, that's 2978 plus negative 22 plus negative 2478 gives us the 478. Okay, so it's the sum of the three areas: the operations, investing activities, and then the financing. If you done renovations, okay, you've done the renovations. How do we recognize it? Huh?
It's an expense.
Okay, some say it's an expense.
The capital expense.
Would we say that, will it depend on the amount that you are putting in as for the renovations? Yeah, because if you compare what you have done, it's just maybe something that you can consider. Is it maintenance that you did, or you extended the factory, or you refurbished the equipment so that you have good drainage? What should we do with that? Yeah, it's structural. Okay, so it will come into the investments. It will come into it's a major thing that you did, so it will feature in the investment. Okay. But at the beginning, before 2005, what was the beginning balance? At the beginning of the year, what was the cash position for the company? And beginning of 2005 was actually what? The end of 2004. So the beginning cash was 2260. You see this one, which is featuring over here, because this was the beginning, end of 2004, which is our beginning of 2005. So we want to find out our cash at the beginning of the year, which is 2260. So at the end of the year, our cash position will be the change that occurred in the course of the year, 478 plus this one. Sorry, plus this one. And this will be the end cash position of our company. It's positive, so I think it's lovely. It's good. Okay, let's go for our tea, and then when we come back, we run away quickly. Ratios. You can do ratio analysis of our financial. Why do we have to have ratios? Ratio analysis. And do ratio analysis. Okay. If we want to look at our past, how we perform compared to the present, how we are performing. There are so many ratios that financials they calculate. There are plenty, but we cannot calculate all of them. We'll look at few of them and see. One which most of us are familiar with, say the net profit margin. Okay, which most of these ratios, most of them are in percentage, others might be in fractions. But we prepare ratios. Why do we have to prepare ratios? Prepare ratios to compare. Yeah, to compare with our own operations. Last year, how we did. This year, how we are doing. Whether we are doing well. There's a possibility that even this year, in terms of sales, you sold more than last year. But when it comes to profitability, maybe last year was even better. And then out of that, you look at what caused that. What caused it that I did not make much profit, though I sold so much. And with the ratios, you go back and then say, okay, maybe it was raw materials. Or maybe looking at what I did, maybe they were filthy. Something have caused it. At times too, when we are preparing the ratios, we prepare also to compare with industry. You know, you are in industry. Which industry are you in? Shea butter, but it's more cosmetics, right? Ah, good. And whatever you are doing, you can find that industry in Ghana. Unless you are coming up with a big industry which nobody knows of. You can always identify the industry that you are in. So which industry are you in? Cosmetics. Okay. And you? Jewelry. Yeah. So is it possible that you can compare with other, the industry standards? That's a difficulty, isn't it? Larry, with our universities and our research institutions, when it comes to industry standards, let's say financials, locally, do we have that? Let's say, I know that for the banks, it's most often easy to get it because most often they publish their accounts. So you can look at how the bank industry, you can pick up about even 6 of them and look at their financials. But there are other areas where, let's say jewelry, where do you get the industry standards in terms of financials?
You may not necessarily get the financials in the form of
what you want,
income statement and balance sheet, and but you can get some indices from the statistical department, statistical services. For instance, when you go there, they can tell you the total jewelry that were produced in a year. If you look at the GDP computation, it's in there.
Right.
And then you have to do some
work back and then right. So
how forthcoming are these officers with information? You know, is this something you go through interviews to get, or and after approaching them and saying, hello, I'm in this business, I'd like to receive X information, they'll actually gladly help you?
Formally, no. Informal, yes. If you are going to go there with your letter and say that I am from XYZ company, I'm looking for YZ information, no. It's just like you are an entrepreneur, a way of getting information. First you go there, you befriend somebody. Oh, so if I want, first time there may be rebuffs, but once you have established a rapport with somebody, you'll be surprised that you can get that information. Sometimes you don't have to pay anything.
And you shouldn't.
Well, you see that there's a difference between the ideal situation and the actual. And it depends on what you want that information for. Okay? So sometimes, even for us as bankers, when we had to go to Bank of Ghana Research Department, there have been times that you have had to take the guy. Because you need information. They will do it for you. But if it's going to take 6 weeks, and you need the data in 3 days, I'm not supporting.
Right, you're saying this
Right.
is the actual.
But I'm saying that the reality is that, but you know, my guys built such rapport with the guys that anytime they got new information, they themselves were passing it on at no cost. So it moved, for the first time, it's maybe, but it moved from there to relationship building. And thereafter, we can have information.
Okay, so the ratios are critical. We need it. They are so much, and if you look through some books, so at times you have so many ratios, but not all of them might be important to you. You pick the few ones that you think are critical to your business, and then you apply it and see how you are performing. We have the profitability ratios to show that your business is what? Profitable. And most often, which ones are we using? We use mostly, want to look at what? Our net profit margin. How do we calculate our net profit margin? Or we've not been calculating? The accountants will do it.
They are not here.
It is that your last figure, which is your net profit. And then you divide it by what? Your sales. Times 100. So it's like your net profit, all right. Divide by your sales, right? Times 100%. So you get your answer in percentage form. And that one will show that, assuming you divide and you get 15%. Well, I got a net profit of 15%. Really, I'm doing well. Because I made 15%. And somebody will ask you, compared to what? Maybe if you compare it to your own past operations, is it a good one? Or if you compare it to the industry, or to what another company that you know that they are doing, or even to a bigger one. You know, some companies, we have smaller ones and then the big ones. If you know how much they are making and see whether actually it is worthwhile. Okay, so we're talking about the net profit. Larry brought in the gross margin, and which means that we need to know what the gross margin is. And before you determine your gross margin, what you have to do, we know that if you go through the income statement, you have your sales, your revenues. Right below that, you have to determine your prime cost. That's the direct cost, which basically is what? Cost of raw materials, those that you can attribute to the sales direct. And then your labor, direct labor. You have to deduct that one. You deduct your raw materials. And those costs, for example, if electricity, it's cost that you can attribute. There are some production units without electricity you cannot produce. And then you realize that it's a big chunk of your cost of production. And you can even quantify it, that for one product that I produce, I need so much electricity. So you can add that one as well. And then once you're able to get that bulk figure as your cost, some will say cost of production or cost of goods sold, those are the direct costs. When you take it out from your sales, then you get your gross profit. And then we divide by the sales again, multiply by 100%, and that will really give us our gross profit margin. And that one is also percentage. If you calculate your gross profit margin and let's say you get 30%, and then you calculate your net profit margin and you are getting 35%, then there's something wrong. I mean, something is strange. Yeah, it shouldn't happen. That's it. Okay. It's acceptable. Oh, what I just did was, yeah, this one, your net profit margin cannot be higher than your gross profit. Okay, let's look at quickly. There is this company which is called what? Kebab business, and we all know kebab. It's a new initial investment that somebody wants to make, and it's called kebab business. Okay, initially there should be an investment. You should put up a structure, you should do A, B, C, D before you can start. And he needs a shed at the market, and it will cost